Previously on the Big Trade series.
It's an honor to have Dan Ferris on the Big Trade series.
What we're talking about here are a group of stocks that I called the World Dominators, and income streams that never go down.
Going back to that Microsoft, we talked about some of the investments that they made in terms of acquisitions.
Even with Microsoft throwing tens of billions of dollars in the garbage, they still just generate tons of cash. It's just unbelievable. It's one of the most cash-gushing, high-return things that's ever existed in history.
Without further ado, we are pleased to present the next installment of this conversation. You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
So Dan, you made a controversial call, I think sometime last year, about selling Berkshire Hathaway. Correct me if I'm wrong. And can you share with the audience how you came to become the Antichrist to basically Warren Buffett from that perspective?
Yeah, okay, look, I don't consider myself as having made like a big call, you got to get rid of Berkshire Hathaway.
Right.
We did write about the Coca-Cola situation, which I really did not think Buffett handled well, properly at all. I think what he did went very counter. It flew directly in the face of what he had preached for so long.
Right.
And let's just leave it at that. We don't want to have a whole big discussion about that. I looked at it and I thought, well, if I wasn't a true believer here and valuing the company the way Buffett tells us to value it, how would I think of it? And, I would have thought of it as a conglomerate and, an insurer. And we looked at it 2 or 3 different ways, and it didn't look really cheap, any of them. It only looks cheap if you take Buffett's word for how to value it, which I think is a little funny.
Right.
So, he could be right. I'm not saying he's being, dishonest or misleading with his recommendation for how to value the company. I was actually, to tell you the truth, Peter, I think I'm getting to the end of my World Dominator trade, which has gone on for over a decade now, and we still have some of those names in the model portfolio, right. Which, in newsletter time, this is highly unusual to hold stocks in a newsletter for years and years and years like this.
Correct.
But I have trimmed out some names like Microsoft and Berkshire and even Walmart, I just didn't think the returns were there. I thought the price was sufficiently high. I didn't think the returns were there anymore. And I thought we could get better elsewhere.
What is this an indication of? Are you indicating to me that indicates somewhat of a potential top in the market by
You'll never hear me answer. No. You'll never hear me say yes to that. No, okay. No.
Okay.
No, I just think that, I was looking for stuff that was really dirt cheap in 2004, 5, and 6. The market was moving up and getting more expensive during those years into the 2007 top there. And so I was looking around, and the only thing I could find that was cheap, and starting about 2005 was like Berkshire and Microsoft and, and then Walmart and ExxonMobil and others. And that's really what started it all. I was just a guy looking for something cheap.
Right.
It was really no more than that. And, it became, since I found one after another, and once you find one of these things and, you give it a cute name in the newsletter business, people start writing and say, hey, I think that's a good idea. And I'm probably guilty of allowing some of the feedback to influence my future recommendations.
Oh, no.
But I just thought that we got some decent results out of it. All the stocks did well. None of them did poorly, and that I was kind of ready to move on. I wasn't finding those anymore.
So this is breaking news. Dan Ferris reconsiders World Dominators as far as future stock picks are concerned. I guess here's the question: is what is going to be your new iteration of identifying interesting ideas based on a value investing premise or fundamental investing premise?
You know, I I don't need a master plan really when it comes to picking stocks. I think a master plan is dangerous because it's like saying you know what you're going to find before you find it. What I'm doing right now is I'm trying to disrupt any bad habits. You know, I normally, what we're doing in Extreme Value right now is we're building a watch list of businesses we really like, which are unfortunately too expensive. I think that's what a good value investor does when, you know, he's having trouble finding cheap stocks. Mm-hmm. But what I did last month in the letter, which just came out Friday, I should say this month in the current issue, just came out Friday. I turned that on its head and I said, well, maybe I'll just find out what's cheap in the world regardless of quality, just based on, you know, price to book, EV to EBITDA, and, you know, what's performed absolutely worse over the last one, and, you know, the worst, very worst performers over the last 1 and 3 years. And of course, you know, there's a lot of oil and gas names and things like that. I mean, it's not a surprise what you find in the list. Although there were a few little surprises. I can't give them away because the issue is very fresh, and I don't want to talk about too many details because, you know, subscribers pay money and they don't want me giving the ideas away. But I did get a few little surprises of some higher quality businesses than I would have suspected to find in there. So I'm going to work through some of that and see if I can come up with a new recommendation out of that by just turning my normal process on its head like that. And otherwise, we'll continue to write about businesses we really like, which, you know, lately have not been cheap enough to buy.
Right. So in terms of like using some of these different criteria relative to world dominators, does that mean that you'll be exploring ADRs and I guess countries that have operations in other parts of the world? I know previously you've dabbled on some companies that have operations in the likes of like China, for example, and Hong Kong. As you know, a lot's been going on in that part of the world. What are your thoughts there?
Well, look, as an investor, if there's a really great business that operates in Antarctica and does really well, I'm interested in knowing about it. But as a newsletter writer, it's really hard to get people interested in stuff that doesn't trade in the U.S. It just is. And I've got one stock that trades in London, and I've written about a couple that trade in Toronto.
Right.
And even then, we've had to do a lot of kind of extra answering reader feedback and telling people how to buy things, and they're always asking about an online broker that'll buy a Canadian stock on the Toronto Exchange. And so just for kind of efficiency's sake, you could call it, or maybe just laziness on our part. Right. We tend to be, unfortunately, U.S. centric and definitely North American centric when it comes to trading venue, and trading venue often means domicile. Yeah. So, I know there are lots of great companies outside the United States, but it's less likely to find us writing about them, unfortunately.
So let's talk about this interesting idea that you came up with, I think about a year ago or something, which I also started to look into quite a bit, which was at that time called MFC Industrial. Do you, as a holdings company, which is extremely interesting to me, do you want to describe what it was that you discovered that was extremely compelling, and maybe the fact that there's some undiscovered elements about this company?
Well, the main thing I liked was the fact that they'd bought oil and gas reserves for really a net enterprise value of about 18 cents an MCF.
Yeah.
Before oil and gas fell completely apart.
Right.
And I also had a previous go-round in the newsletter with that stock, and we'd recommended it before, and they did a bunch of spin-offs and things, and our readers who follow our advice made a couple 100%.
Right.
So I had a good feeling. I was probably prejudiced by that. I'm just a human being after all. And, I thought Michael Smith, he's the guy who's been running the company for a couple of decades, and
Yeah.
he's a really good kind of distressed, deep value kind of an investor. But things are different this time. Smith has been CEO and CFO and chief cook and bottle washer and everything for a long time, but in the past year or so here, he's not anymore. He's has some title like executive director or something. And now there is a CEO and a CFO and a chairman. He was chairman before. Mm-hmm. And so it's different. And it looks to me like, and I actually had a conversation with him that hinted at what we're seeing, which is the building of a kind of a large commodity trading and services type firm. Like Noble is one in Asia,
Yeah.
He specifically mentioned Noble. He said, a long time ago, it wasn't as big as it is now, and it was a really great bet, really great long-term bet, and maybe we could do that too. So, I think I made a mistake on some of the asset or one of the assets this time. The iron ore asset. They have a royalty on the Wabash mine. Of course, the Wabash mine is shut down permanently. And I didn't really see that coming, even though, like, the people I know in this world who know a lot about that area of the world and a lot about iron ore kind of said, be careful here. I thought I knew better because I figured, well, at a dirt cheap price, how can you go wrong? And you can go very wrong. And there's also an iron ore asset in the U.S. that I think could be a problem because it's not large enough to get scale, and there were big plans to develop that because they own some waterfront real estate along the Mississippi, and they own the iron ore mine, which it's very high grade, but just not large enough. Probably, I'm guessing there. Mm-hmm. So I think I made a couple mistakes on the iron ore assets, which is why we didn't do so well with that stock this time around. But I think longer term, it's not that company anymore. It's right. They're building it into something else. And that could be a different bet entirely and a much better longer term bet, frankly. The model was do a transaction and spin off a business, and do a transaction, spin off a business. So it was constantly just morphing into all these different things, and you'd wind up with, over years, if you held the stock, you wind up with 6 or 7 different shares trading on all these different weird places around the world. Mm-hmm. And now I think you're more likely to see a real business that has a chance of growing and becoming something much larger in 10 years or so.
On that very subject, taking MFC, thinking about Microsoft and many of these basically from very small companies to very big companies, I noticed that there's certain characteristics in terms of, like, especially from a sum of parts component on many of these companies, that allow them either as operating businesses or holding companies to have many of these investments or operating businesses within them. Do you believe that there are more inherent inefficiencies in companies that are kind of structured like this, where there's many different businesses and investments under one listed, group company, as compared to basically a simple operating business that you could examine its financials quite clearly? And is there an inefficiency there, you think, that can lead to a edge in terms of investing?
There certainly can be. The more different businesses you get under one roof, the more chance there is that you have, different credit profiles and different customer relationships and just very different kinds of goals. Mm-hmm. And after a while, it's people talk about this barbell phenomenon where, In the middle, maybe there's a business that doesn't have very good operating characteristics, kind of difficult. And then on the ends, there's something with, wonderful thick margins or something.
Right.
So it's very lumpy and uneven and just too different to be under one roof. Absolutely. And you're seeing, I think, at a time like this, kind of late, mid-late, whatever kind of cycle you want to say we're in, just call it late. Mm-hmm. It's a good time to get a company public. So there's a lot of spin-offs happening right now. And I think that's one place where we've focused more lately for that reason. And we found, a couple of really good ones, I think. I mean, last October, we had recommended ADP, Automatic Data Processing, the largest payroll processor. And they spun off their, basically just think of it as their automobile IT services unit. And we looked at it and thought, wow, this is a great business. So we recommended that separately. And the thing doubled like in a matter of months.
Right.
I think part of the reason for that is because people are getting desperate for really great ideas. And, you don't get a phenomenal business like that spun off because it's the biggest one of its kind in the world. And it's, got all those wonderful characteristics, those 5 clues and everything, or at least 4 of them. We'll see how good they are at dividend paying. So, I think it is more like you are more likely to find some inefficiencies, and now's the time where people are trying to iron them out and spin off a lot of different businesses.
That's a fascinating comment, and I think that should lead us to our fast question, because I know we've been last question. I know we've been talking for quite some time. Let's imagine, for example, if Dan, if you're running a listed company, for example, and based on what you just said, what aspects would you be thinking about when you're running this company that would make it as attractive as possible to investors? And what would you do from the perspective of some of your subsidiaries to put them in a position to benefit post-spinoff?
Okay. Now I know this answer might sound like it's a little bit unfair to your question, but okay. The first thing I try to do is prevent the thing from going public. I try to keep it private
as long as you can.
Yeah.
Okay.
Yeah, because I really I'm amazed at somebody. There are very few of them, but there are I guess enough to talk about. Public companies run by really good people who seem to do a great job of juggling the shareholder value side with the, keeping your employees and your customers happy side. Those things don't automatically align. Customers, for just a typical example, customers always want to pay less. And other things being equal, the business would like to charge more. Let's say not all businesses can be Microsoft or like a discount house or something. Mm-hmm. So there's more chance for conflict. But I'll tell you what I would do. Mm-hmm. I would try to be in a business in the first place that was a relatively high return business with relatively low upfront and ongoing capital requirements.
Right.
And if I develop, and I would really try to keep myself from expanding for its own sake. I would only want returns-based growth. I wouldn't want to be in a business where market share growth. Like I would have a tough time running a large iron ore company today, like Rio Tinto or BHP, because those guys that, yes, they do have very low cost, well below what the prices are now, but the idea of seizing market share like that and continuing to ramp up supply amidst falling prices, it would just drive me absolutely crazy. So, I'm sorry, Pete, I don't even know if I answered your question.
It's an interesting perspective. We were basically talking about how you would, what kind of business model you'd be utilizing with this, say, public company, and juggling the needs of the clients and shareholders and employees. Although you're saying that that's a difficult to achieve task, and only very few people can do that very well. Is that what you're implying?
Yeah, really well. That's right. Because I think few people have the discipline to be actually like the people in the book you mentioned, the Thorndike book.
Yes.
Those guys are all very, very disciplined, return-focused, excellent capital allocators. And that's really what I'd want to be as the leader of a public company, because I would figure that treating the shareholders well, financially would follow from that. And I'd want to keep a tight rein on the capital structure. I'll tell you, it's normal. I know it's normal, but boy, every time a public company gives away an option or a share, it just makes it bristle. Giving the equity away like that, it just feels wrong. But I know it's normal. It's an expense.
So you think that equity is king, from a perspective, right? There's always people sayings like never give away equity. Is that what you're trying to say?
Yeah, I mean, obviously those kind of prescriptions can't be lived up to. Never give equity away. I mean, but yeah, equity is that's who the shareholder is. He's the equity holder, and there are many, with the most public companies that we talk about or come across, there are many outside passive minority equity holders. And, the board of directors is supposed to look after them, but, with human beings being what they are, if you're sitting 2 feet away from the CEO, you're not sitting 2 feet away from the outside passive minority shareholder. Who are you really who's going to have more influence over your behavior?
Right.
So I would, I think I would prefer to be a board member than a public company leader, because I would make it crystal clear from day one, I'm here for the outside passive minority shareholder, and I'm not here for anybody else, and I'm not here to make friends even necessarily. So, if I were on Coca-Cola's board, I'd have no trouble saying this compensation package is terrible. It's not going to fly. I'm going to go to the Wall Street Journal tomorrow, which I wouldn't give as an insider and a board member. I wouldn't be able to do that, but I'd certainly vote it down and just look everybody in the eye and say, "You got to be kidding me."
So, okay, I know I said that was the last question, but if you don't mind, love to get your whole view. I know you're very passionate about a lot of the things that are happening around us. I've heard you share some insight on both politics and economics. You've insinuated some stuff about Warren Buffett as well. Let's just tackle that very quickly. Like, what's basically Dan Ferris's outside of investing paradigm of what makes a good economic model?
A good economic model? I'm not sure what you're asking.
I guess I'm heading towards more of like
are you
school
okay?
of thought.
Oh, I see. Are you asking me if I'm like an Austrian or a whatever?
Sort of. I think you've. I've heard you previously discuss about some views. You've always had some harsh criticism towards a lot of the certain political events that are happening in terms of the newswire. So I don't know if that's ever been clearly defined or not about like how you. What kind of economic school of thought you come from, and if so, how does that affect how you view about all the current events that are happening right now?
The more I live, the older I get, the less willing I am to do this. Like 5 years ago, I would have been saying, I'm a libertarian, Peter, and blah, you would have had trouble shutting me up. But now I'm skeptical of people who say they know politics and politicians. A friend of mine said, I'm going to vote for Bernie Sanders because I think he's, better than, and he named a couple other people.
Right.
And I thought to myself, I wouldn't say this out loud, but at the time I just thought, man, you don't know Bernie Sanders from Adam, and if he really wants the job, could he possibly be the person for it? With the U.S. presidency, anybody who really wants the job, could they possibly be the right person for it? I tend to think, I'm skeptical of that proposition. So, politically, I want to be kind of left alone, and I want us to start by leaving each other alone and not infringing on each other's persons and property.
Right.
And behaving like decent human beings towards one another. And I think the more you get governments or anybody, I don't care who it is, a corporation or, the local high school football team or someone forcing you to behave in a certain way, the worse off we all are, and kind of the worse we tend to behave in the aggregate. I think when we're allowed to just leave each other alone and we have some clear rules like, just basic law and order, that seems to work best to me. But, I don't pretend to be an economist or a political scientist, if there is such a thing. And, as far as economics goes, you lay all the world's economists end to end, you wouldn't reach a conclusion. So I think, again, with economics and with politics, with all these things, just circling back to investment, one of the great mistakes I believe investors make is to get too scared of these macro-type political and economic events. I'm sure there are people today, and, judging by the reaction of like the S&P 500 or the Dow, there are people who sell stocks because of things happening in Greece.
Yeah.
And that's a mistake if you're holding on to a good business. That's a big mistake. That's what interrupts your compounding. And that's why most people, if you look at the Dalbar study, pretty famous study,
yep. They
do quantitative analysis of investor behavior, QAIB study. And over 20 and 30 years, most investors make less than 3 or 4% a year, sometimes 1% a year during some of these periods of their study. It's an ongoing study, and they update it every year. So people are terrible at this because they do get too upset about these bigger macro things, and they think it's really important to keep up with the news. But news is mostly just noise, and it gets in the way.
What does your day consist of in terms of, like, are you observing? Let's take the newsletter editor component out of this and think about it more from the perspective on how you're picking stocks or how you're interacting with new information flow, or is it very quiet? Or are you just like reading, like staying with high conviction for your ideas, or are you extremely malleable to new information? What is your day like in terms of all of this? I guess your professional life is concerned.
Well, I have deadlines. I do all of this primarily in service of publishing the newsletter and doing our weekly updates. One of which is due in about less than an hour here. And so I'm writing. Writing is a very time intensive thing, and so you do a lot of writing. But the rest of the time, I spend more and more time just looking at one individual company after another and asking myself, what are my preconceived notions? What are my preconceived notions right now about, all these beat up oil and gas stocks? Yes, I know they depend on commodity prices. Yes, I know many of them are highly indebted. But I can't believe, a screen of 200 or 300 really dirt cheap names with a lot of oil and gas and other kind of distressed looking things in them. I can't believe, Peter, that there isn't one or two really great ideas in such a list. I just can't believe that. I certainly don't believe that one or two of those stocks won't perform well over the next year or two. And so I'm setting about finding those, and I'm setting about looking at these spin-off ideas one at a time to see what the best ones are. So that's really...
Are you listening to like the conference calls, reading the annuals, the quarterlies, reading all the news wires about the companies? Is that the interaction that you're having when you're thinking about these companies?
Yep. 10Qs, 10Ks, conference calls. And, we read a little bit of other proprietary research,
Right.
Expensive, high-end type of stuff. And I have a Bloomberg, and I use it quite a bit, just mostly for equity screening and little else. And some research, there's a very good financial analysis capability there. So, yeah, I'm doing two things these days. I'm looking for good businesses, whether they're cheap or not, and I'm looking for what's super dirt cheap and trying to find something good among it, and just going one at a time.
Dan, it's been an absolute pleasure having this conversation. I know it's been much longer than you anticipated.
Yes, thank you very much. And yeah, it went longer, but that's okay with me. I had a great time.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.